Real estate investing can be a lucrative and rewarding venture, but it's not without its challenges and risks. Whether you're a novice looking to dip your toes into the world of property investment or a seasoned pro seeking to refine your strategy, it's crucial to arm yourself with knowledge and a well-thought-out plan. In this guide, we'll provide you with valuable tips and insights to help you navigate the intricacies of real estate investing, from choosing the right properties to managing your investments effectively. Whether your goal is to generate rental income, build long-term wealth, or diversify your portfolio, these tips will serve as a solid foundation for your real estate investment journey. Number 1. Educate yourself. Before diving in, thoroughly educate yourself about real estate investing. Read books, attend seminars, and consider online courses to understand the fundamentals. Learn about different types of real estate investments, including residential, single-family homes, multifamily units, commercial, office buildings, retail spaces, industrial, and more. Study your local real estate market and broader trends to understand supply and demand, property values, and rental rates. Learn about mortgage loans, interest rates, down payments, and financing options. Familiarize yourself with real estate laws, contracts, and tax implications related to property ownership and transactions. Connect with real estate professionals, including realtors, property managers, contractors, and attorneys. Attend local real estate investor meetups and join online forums and social media groups. Number 2. Set clear goals. Define your financial objectives and risk tolerance. Are you looking for long-term wealth accumulation, passive income, or a mix of both? Your goals will guide your investment strategy. Start by understanding why you want to invest in real estate. Is it for rental income, long-term wealth building, or short-term capital appreciation? Are you looking for passive income, a retirement fund, or a career change? Knowing your purpose will guide your goal-setting process. Your goals should be specific and measurable. Instead of saying, "I want to make money in real estate," specify how much money you want to make and in what time frame. For example, "I want to earn $5,000 per month in rental income within 5 years." Establish a clear time frame for achieving your goals. This timeline will help you stay motivated and track your progress. Make sure your goals are realistic within your chosen time frame. Real estate investing often involves significant financial commitments. Consider how much capital you can invest, what your risk tolerance is, and how you plan to finance your investments. Set financial goals that align with your resources and risk profile. Number 3. Budget and financial planning. Budgeting and financial planning are critical aspects of successful real estate investing. Whether you're a beginner or experienced investor, having a well-thought-out financial strategy is essential. Determine your budget and financing options. Consider factors like down payments, mortgage rates, and ongoing expenses. Create a comprehensive financial plan to ensure you can sustain your investments. Start by clarifying your objectives. Are you looking for long-term wealth accumulation, immediate cash flow, or a combination of both? Determine how much money you want to invest in real estate and over what time frame you plan to achieve your goals. Calculate your current income, expenses, assets, and liabilities. Determine how much disposable income you have available for real estate investments. Develop a budget that outlines your monthly income and expenses, including housing costs, utilities, groceries, transportation, and other essential items. Allocate a portion of your budget to savings and real estate investments. Number 4. Location matters. Location is critical in real estate. Research areas with strong growth potential, good schools, low crime rates, and amenities that attract renters or buyers. Local knowledge is key. The location of a property has a significant impact on its value. Properties in desirable neighborhoods or areas with strong job markets tend to appreciate in value more quickly than those in less attractive locations. Investing in properties with strong growth potential can lead to substantial returns over time. Location also affects the demand for a property. A well-located property is more likely to attract tenants or buyers, reducing the vacancy period and ensuring a steady income stream. In contrast, a poorly located property may struggle to find occupants. Researching future development plans for an area can provide insights into its growth potential. New infrastructure projects, commercial developments, or transportation improvements can boost property values in certain locations. Location can also play a role in risk management. Investing in diverse locations or areas with a history of stability can help spread risk and protect your investment portfolio. Number 5. Property type. Decide on the type of property you want to invest in. Options include single-family homes, multifamily units, commercial properties, or even real estate investment trusts, REITs. Each has its own advantages and risks. Single-family homes. These are standalone houses suitable for renting to individuals or families. Multifamily homes. These include duplexes, triplexes, quadplexes, and apartment buildings, offering multiple rental units within a single property. Condominiums, condos. Individual units within a larger building, often offering shared amenities like a pool or gym. office buildings, multi-story structures suitable for renting office space to businesses, retail spaces, commercial storefronts, shopping centers, or malls for retail businesses, industrial properties, warehouses, manufacturing facilities, and distribution centers, mixed-use properties, buildings that combine commercial and residential spaces. Number 6. Market research. Keep a close eye on market trends and cycles. Look for emerging markets or areas where property values are expected to appreciate. Avoid speculative bubbles. Research different markets and locations to identify areas with growth potential. Consider factors like job growth, population trends, economic stability, and local amenities. Decide on the type of properties you want to invest in: single-family homes, multifamily units, retail, office, or industrial. Understand the pros and cons of each property type in your target market. Evaluate market trends. Study historical and current market data, including sales prices, rental rates, and vacancy rates. Look for trends in property appreciation, neighborhood development, and demographic shifts. Examine the local population demographics to determine your target tenant or buyer profile. Understand their income levels, preferences, and housing needs. Property condition and inspection. Conduct thorough property inspections to assess the condition of potential investments. Estimate repair and renovation costs accurately. Number 7. Due diligence. Due diligence is a critical process in real estate investing that involves thoroughly researching and assessing a property before making a purchase. It helps investors make informed decisions, minimize risks, and maximize returns. Before making an offer, conduct thorough due diligence. Inspect the property, review its financial history, and assess potential repairs or renovations. Also, consider the local zoning laws and regulations. Define your investment objectives, such as the type of property you're interested in: residential, commercial, industrial, your target location, budget, and expected return on investment, ROI. Research the local real estate market to understand trends, demand, and supply dynamics. Look for factors like job growth, population growth, and economic stability. Identify potential properties that meet your criteria. This can involve working with real estate agents, searching online listings, or networking with other investors. Obtain and review all relevant legal documents, including title deeds and title insurance. Property surveys, zoning and land use regulations, environmental reports, any lines or encumbrances on the property. Number 8. Risk management. Risk management is crucial for success in real estate investing, as it can help you protect your investments and make informed decisions. Diversify your real estate portfolio to spread risk. Don't put all your money into a single property or location. Consider different property types and geographic areas. Conduct thorough market research to understand the current and future trends in the real estate market. This includes analyzing supply and demand, economic indicators, job growth, and population trends. Choose your investment properties carefully. Location is a critical factor in real estate success. Consider factors like proximity to amenities, schools, transportation, and crime rates. Diversify your real estate portfolio by investing in different property types: residential, commercial, industrial, and in different geographical areas. This can reduce risk by spreading it across various investments. Develop a clear exit strategy for each investment property. This plan should consider factors like when and how you will sell or refinance the property. Consult with legal and tax professionals to ensure you are in compliance with all laws and regulations. It can also help you structure your investments in a tax-efficient manner. Number 9. Property management. If you're not planning to manage the property yourself, hire a competent property management company. They can handle day-to-day operations, maintenance, and tenant issues. Property management is a crucial aspect of real estate investing, especially for individuals who own multiple properties or those who don't have the time or expertise to handle the day-to-day operations of their real estate investments. Property management involves the oversight and maintenance of rental properties to ensure they generate income and appreciate in value while minimizing hassles for the property owner. Property managers are responsible for finding and screening tenants. This includes marketing the property, conducting background checks, verifying income, and evaluating potential tenants' rental history. Property managers oversee the maintenance and repair needs of the property. They arrange for regular maintenance, address tenant maintenance requests, and handle emergency repairs. Keeping the property in good condition helps preserve its value. Number 10. Exit strategy. An exit strategy in real estate investing is a plan that outlines how an investor intends to sell or dispose of a property to realize a profit or achieve specific financial goals. Having a well-thought-out exit strategy is crucial for successful real estate investing, as it helps you make informed decisions about acquiring, managing, and selling properties. Have a clear exit strategy. Know when you'll sell or refinance the property. Consider tax implications and capital gains. An exit strategy helps you achieve your financial goals. Wholesalers find properties at a deep discount and then assign the contracts to other investors for a fee. They never actually purchase or own the property themselves. The exit strategy here is to find a buyer willing to pay more for the contract than what you paid, thus making a profit. Thanks for watching. Hope you like it. Subscribe to the channel and hit the bell icon.